Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, February 28th, 2022. Welcome back to the podcast, Sekido-san.
Good to be back.
It's good to have you after a 1-week hiatus, and what a week it was. So plenty to talk about. Obviously, we should start off with the Ukraine. Developments there have been certainly moving fast. In addition to obviously the human tragedy, I think it would be good to understand how the markets in Tokyo have reacted up to this point. And obviously the big question is, how do you expect markets to react going forward?
Okay. Yen basis has been the biggest mover over the last weekend. There is more demand for huge sums of US dollar funding. This has resulted in a discount of 3 to 12 months dollar yen basis to expand by 20 basis points or more. This is because Japanese investors have been holding dollar assets and prudently demanding more funding for dollar assets. Overseas investors have been dumping Russian assets at a faster pace. They will likely accumulate dollar funds through the end of the March, but global investors will at some point shift their abundant dollar funds not only into US Treasuries, but also into JGB asset swaps. In our view, rather than yen basis continuing to widen, JGB asset swaps will cause the widening to pause along the JGB auctions in the first week of March. The 10 years JGB yield is currently around 0.20%, but we expect it to start to decline ahead of the fiscal year end as Japanese investors have their abundant yen funds to buy JGBs. Also, overseas investors may buy more JGBs on their flight to quality behaviors amid the uncertainties of Ukraine. JPX weekly flow data shows that the Japanese investors have been unloading K-rates cross-held Japanese equities at a faster high rate. Overseas investors buying and selling of Japan stocks have been mixed, and the weakness in Japan stocks appears to be due to Japanese investors unloading K-rates cross-held equities. Dollar yen is likely to remain well supported both from surging oil prices as well as Japanese importers' yen selling flows. Aversion to risk driving a yen rally should not be banked upon. In this way, the yen cross-asset pricing action does not necessarily draw typical analogies, but mirrors the Tokyo market's microstructure directly. Investors should analyze events calmly and not assume that all pricing action is determined by the events in Ukraine.
Yeah, that's a great point. There's obviously a ton going on, in the markets in addition to that, and forces pushing or pulling in different directions. Switching topics somewhat, the JSDA released January data last week. When you see markets react the way that they have, it's always helpful to better understand where the market was heading into an event. So let's start with overseas investors. What were they doing in Japanese markets during the month of January?
JSDA data released on February 21st shows that overseas investors net bought a total of 24.3 trillion yen of JGBs in January. Broken down, they were net buyer of TDBs by 24.1 trillion yen, medium-term JGBs by 351 billion yen, and super long-term JGBs by 225 billion yen, but net sell of long-term JGBs by 371 billion yen. That was not so big, but changed to the net selling side after the recent 2 months net buying 1.7 trillion yen in December and 1.2 trillion yen in November. In January, foreigners unloaded long-term JGBs as yen yields rose. Foreigners selling of JGBs in January appear to have laid the background for the BOJ's fixed-rate JGB buying operations in February.
Okay. So we're starting to see what led to that sell-off that took 10-year JGB yields almost to the BOJ threshold of plus 25 basis points. So now we know what foreign investors doing. So while they spent January selling JGBs, what were Japanese investors up to?
Okay. In January, the Japanese pension funds acquired a net 1.2 trillion yen of yen bonds, and the lifers continued to net buy super long-term JGBs by 898 billion yen. Especially the Japanese banks net bought 3.3 trillion yen of yen bonds. Particularly, Citibank's net bought 1.1 trillion yen of medium-term JGBs and 763 billion yen of long-term JGBs, but unloaded a net 146 billion yen of super long-term JGBs. Japanese banks overall accelerated their net final foreign stocks and investment fund holdings by 598 billion yen, while net unloading medium to long-term foreign bonds by 331 billion yen. Japanese banks built up their JGB positions in January, alleviating the effect of JGB yield rising. Also, they improved their yield by buying more alternative investment instruments.
Got it. Yeah, well, perhaps as that sell-off accelerated in the early part of February, maybe they turn net sellers as well. I suppose we'll have to wait until the February data is out. So I think that was a pretty good overview of where we were, market reaction, and where we're going. But I'd like to get a little bit more specific and discuss your outlook for across various markets: yen rate, spot dollar yen, and yen basis.
While market sentiment has darkened because of the uncertainties surrounding Ukraine and the dollar-yen scene has been heavy, however, downside has been limited relative to the growing of geopolitical risk, and the dollar-yen has stayed within a range. Events in Ukraine will be a key to market moves. A military clash will send oil prices higher, driving concerns of inflation, and this would likely support a weaker yen. Over the near term, we now see neutral bias for dollar yen, with trading in a 2.5 yen range between 113.50 to 116. The yen rate swap curve has declined and flattened. Yen rates rose out of the BOJ's fixed rate JGB buying operations, but have started to fall because of Ukraine. Downward pressure on the JGB rates will clearly go over the near term. We now feel the yen rates will shift from neutral to downward. Though the front end through the valley of the yen basis curve has widened, the long end has tightened. Ministry of Finance weekly securities flow data for February 13th to 19th shows that Japanese investors unloaded a net 60 billion yen of foreign securities, as foreigners net bought 2.7 trillion yen of Japanese securities. Japanese investors unloaded a net 56 billion yen of foreign stocks and investment fund holdings, and a net 44 billion yen of short-term foreign bonds. But they net bought 40 billion yen of medium to long-term foreign bonds, displaying a strong demand for foreign bonds. Foreigners bought a net 2 trillion yen of short-term bonds and a net 939 billion yen of medium to long-term yen bonds, as flows into yen bonds picked up. But they net sold Japan stocks and investment fund holdings for fourth straight week by 261 billion yen, continuing to reduce their risk exposure to Japan stocks. If the Ukraine crisis continues to put stress on global financial markets, then foreigners could more actively turn to JGB arbitrages, which could limit yen basis widening. In our view, however, strong demand among the Japanese for dollar asset funding and among the foreigners for JGB asset swaps are interlinked and balanced, and we expect the yen basis to maintain a neutral bias.
Okay, so neutral on both dollar, yen, and basis, but bullish on JGBs, and really interesting. I mean,
Right.
I think you could almost say that the biggest flight to quality rally has our biggest flight to quality beneficiary has been the basis. We've seen some huge moves there. So interesting. It'll be interesting to see if it does in fact stabilize here. So fascinating stuff as always, Sekido-san. Thank you for joining us.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.